Hi everyone, I am Kyungju, investment analyst at the Endowus Investment Office, and I'm here today to talk about the China fixed income portfolio. Here with me today is Sam, Chief Investment Officer of Endowus, who will kickstart an introduction of the portfolio.
Thank you, Kyungju. So this China fixed income satellite portfolio is really interesting. It combines with the China equities portfolio to provide a holistic exposure to the China financial markets. The China fixed income portfolio is designed to capture China's developing and deepening fixed income market. So through the portfolio, you can gain both an onshore and offshore allocation, especially to corporate credit, which is growing very rapidly in China, but also meaningful exposure to the China government bond market as well. So the healthy exposure to Chinese fixed income market is opportune because it's very difficult to find yield in global fixed income markets these days. And China provides an opportunity to gain yield and long-term growth as well. So if you look at the underlying funds that are making up the portfolio, it's a very simple portfolio made up of the BlackRock China Bond Fund, which is a broad, diversified, go-anywhere tactical allocation fund that gives you exposure to both the onshore and the offshore exposure for China. Primarily, it's a corporate credit type of portfolio, but it does have exposure to the government bonds. Now, that is balanced out by the new Berger-Berman China Bond Portfolio. This is primarily an onshore-focused portfolio that is opportunistic. So it's an actively managed portfolio, and its primary exposure, again, is credit, but across a broad spectrum of duration and credit risk, and also giving you some exposure to government bonds as well. So these portfolios are supposed to provide you with some downside protection and good yield for the long term, and balance that out together with the China equities portfolio. So I'm going to hand back to Kyungju now to explain why we invest in China fixed income.
Thanks, Sam. Well, as a start, the Chinese fixed income space might be pretty unfamiliar to some of us, but it's quite similar to the Chinese equity market in the sense that it has shown a favorable high level of growth in its past trajectory. And this is the same whether you consider the onshore China fixed income market or the offshore China fixed income market alike. And what's interesting, again, similar to the Chinese equity market, the Chinese bond market is actually the world's second largest bond market following the US. And if you drill down deeper into this fast-growing and large universe, you can see that the sectors are pretty diversified as well. Around half of the bonds are issued by the government, so this includes the central government, the regional governments, as well as the state-owned enterprises, while the remaining half are corporate credits from various sectors. And on this point, I would like to draw your attention to the sector colored in yellow, which is the real estate sector. The real estate sector, as we all know, has been going through a lot of negative attention today due to the inability of some property developers to pay their debt. And there's a lot of clients who approach us asking us, hey, is it still safe to invest in Chinese bonds? Because real estate is just pulling everything down. And we'd like to reassure them that, okay, if you look at the sector allocation, real estate is just a small portion of the entire China bond universe. And although it is true that there are some market volatility out there right now, it's actually based more on anxiety and contagion rather than the underlying fundamentals of the entire sector. So given that the universe is large and diversified, we think that the Chinese bond market still makes a good investment case. Second reason might be the single most important reason as to why you should invest in Chinese fixed income. And it's because Chinese bonds have a really low correlation to not only compared to global bonds and global equities, but also to Chinese equities and even within the China bond universe. And this is really because Chinese bonds, they're less impacted by global rates environment, but actually they're more impacted by the rates direction set within China. Additionally, there's also a low correlation between the onshore and offshore Chinese bonds within the China bond space because they're denominated in different currencies. So for example, the onshore bonds are denominated in Chinese yuan, while the offshore bonds are typically denominated in Hong Kong dollars or US dollars. And all these currencies are subjected to different market forces. So all in all, adding some Chinese bond exposure in your portfolio would give your portfolio a natural protection against other asset classes. And lastly, Chinese bonds are also popular, like Sam mentioned just now, because they offer higher yield. So if you look at this chart, for example, you can see the yields of the Chinese onshore and offshore government bonds in blue, and they're really pretty high in the universe. maybe the other countries that would pay a comparable level of yield in the government bond space would be from more other emerging market countries like Malaysia or Philippines. Otherwise, you already have to go into the riskier corporate credit sector, which is shown in green. In the same regard, Chinese corporate credits, they also pay a higher yield than their global counterparties. So for example, Chinese investment grade credits, they pay a higher yield than global investment grade credits. So again, adding China bond exposure can be a good idea if you're looking for yield pickup. So with all these benefits, again, we come to the question of who should invest in China fixed income. And again, this is important because the Chinese bond market, it can be pretty volatile because they're not only subject to the events happening in the rest of the world, but they're especially heavily impacted by the political and regulatory risk arising from within China. And so you can see there's a lot of up and downs throughout the growth of the China fixed income market. And due to this, we only suggest investing in China bonds if you are prepared to withstand the potentially steep losses arising from market volatility, or if you have a very conservative risk tolerance, or if you have a mid to long-term investment horizon to make sure that your investments will ride out the losses when they happen. So I will pass my time back to Sam, who would guide you through on why you should invest in the Endowus China fixed income portfolio.
Thank you, Youngju. So I'm going to touch on two major points. First is the nature of an actively managed fixed income portfolio. The opportunity set is quite broad, and as we mentioned, the China fixed income market is broadening and deepening. So we have multiple sectors in which we can invest in, and multiple also credit, government, and multiple issuers. Also, you can take risk according to the duration of the various fixed income opportunities that exist. So we really like BlackRock and Neuberger Berman's opportunity to actively manage the portfolios for us. And while the historical performance is no indicator of future performance, if you look at the risk-adjusted return of the Sharpe ratio, a 0.63% return Sharpe ratio is actually not a bad ratio. The China fixed income market is still a nascent market, so the indexes that exist are not representative of the broader China fixed income market. So we've used opportunity to look at various different China fixed income indexes, and there's very many, as you can see. So please take a look at this and look at the exposure that it has for the different segments. But combine it together, we would like to provide a broad diversified exposure to both onshore, offshore China, and provide you with a defensive nature of the China fixed income portfolio that Endowus has created, which would complement any exposure that you would have, especially in the China equities market. So having a balanced portfolio, having some China's equities and China fixed income would be a great way to do it. Also, I have to highlight that there is higher risk in the China fixed income market than global diversified portfolios. So something that is in between could be something like an emerging market portfolio, which now has deepening and meaningful exposure to the Chinese fixed income market, but also gives you other opportunities. And there are many emerging market fixed income funds, single funds, that are available on the Endowus Fund Smart platform. One of the key benefits of investing in this China fixed income portfolio is also the fact that Endowus's investment office is actively assessing and on an ongoing basis the underlying portfolios, underlying funds in the portfolio. So the Endowus investment office curates and assesses the whole fund universe of Chinese fixed income market, which is becoming much longer and broader. And we do qualitative and quantitative assessments on these funds to make it the building blocks as true best-in-class funds within the China portfolio. Also, as an ongoing reevaluation, we look at whether the portfolio's underlying funds are being consistent with their investment philosophy, its process, and its strategy. And if there is any deviation, then obviously we will look at that as an opportunity to maybe take out a fund, or in the future, if there are more opportunities to include new funds, we can do that by replacing funds or adding it into the portfolio. So this ongoing assessment and ongoing curation and advice that the Endowus Investment Office is a key feature of the China fixed income portfolio. So with that, I'm going to hand back to my colleague Kyungju to go into a more deep dive of the underlying portfolio.
Thanks, Sam. So if you go back to the portfolio allocation, maybe some of you might ask, hey, why is there only 2 funds? And this really reflects the limited choice for Chinese bond funds available out there for retail investors in Singapore. But again, as Sam mentioned, the investment office is always monitoring the funds as well as the universe to look for any other good funds that we can introduce so that we can make sure that we always offer the best solutions for you out there. So when constructing the portfolio, again, we have worked really hard with the respective fund managers to bring a high level of rebate. So the net expense to invest in this portfolio is only about 0.82% per year, which I think is, again, one of the cheapest options to gain a diversified and an efficient exposure into the Chinese bond market. Well, so the resulting portfolio has pretty favorable returns over the long term with a lower volatility than the respective onshore and offshore market indices. This is all the information that we have prepared for this presentation. If you wish to learn more about this portfolio in general, please refer to the Endowus Insights. Thank you.